It's earnings season. This week, 36 companies reported with the banks dominating, and I think we are on the cusp of a major M&A wave in regional and community banks for the first time since the 1990s. Right now, I think we are in a normal cycle. Yes, there are signs of credit deterioration on the commercial side, but not enough to actually cause a recession or indicate that a recession is about to occur. My conclusions about credit quality are not just an opinion, but driven by reams of data that the banks provided this week. My takeaway from looking at the credit quality statistics is this. Hi, this is Steve Eisman, and welcome to another edition of the Weekly Wrap. This is for the week ending October 17th, 2025. In international news this week, well, let's just say the week started on a pretty wild note. On Friday of last week, President Trump threatened 100% tariffs to retaliate with respect to China's moves on rare earth metals. The stock market swooned last Friday, with NASDAQ down 3%. By Monday morning, President Trump put out a post on Truth Social saying, quote, "Don't worry about China. It will all be fine." So the market on Monday had to unswoon by rallying back to regain more than half of the losses from Friday's rout. On Tuesday morning, the market declined again as China imposed sanctions on the U.S. units of a Korean shipbuilder. My summary is, the trade story between China and the U.S. is not over. There is a lot of gamesmanship going on, and the market trades every frickin' headline. Chances are they'll probably work it out. I certainly hope so. And maybe I'm just saying maybe we don't have to trade every headline. It's earnings season, and I'll spend most of this wrap in the weeds on what companies reported for their third quarter earnings. The number one takeaway about why we pay attention to quarterly financial reports is the check our thesis. Since my general investment approach is long-term, to make a good choice and hold it, we use these quarterly numbers to check whether our thesis is intact or are the numbers shifting enough that we want to change an investment decision. Buy, sell, or hold. They are all three investment decisions. Doing nothing can take as much guts as buying or selling. So here we go into the weeds of industries reporting their earnings like herds in the Sahara. First come the banks, like the gazelles, and later come the other industries. Banks led off reporting season this week. The results were generally quite good, and at first, bank stocks rallied. The large banks all beat, with strong investment banking and trading helping out the larger banks and investment banks. M&A fees were strong across the board, as M&A activity has really picked up. Trading and underwriting fee results were strong as well. It's clear to me that we are at the beginning of a massive M&A wave. And how do you play it? Well, in large cap stocks, you own Goldman or Morgan Stanley. Otherwise, take a look at the investment banking boutiques like Evercore and PJT Partners. In the banks, for those who are looking for some clear signs from bank reports that there is big economic deterioration, well, those people did not really get what they wanted. Credit quality was okay, and loan loss provisions were fine. Now, there was some deterioration on the edges, but not enough to raise real alarm bells. We're going to dig into this. Consumer credit quality really was fine. So there are no signs yet that the slowdown in employment is having an impact on consumer credit quality. But again, this is just the banks I'm talking about. But on the commercial side, there were some issues. On the JP Morgan earnings call, Jamie Dimon said that auto-related company bankruptcies reveal early signs of excess in corporate lending. And also, JP Morgan took a $170 million loss on the Tricolor fraud bankruptcy. But I want to add here that for a bank the size of JP Morgan, a $170 million loss is tiny. Now take a look at this table. This shows commercial non-accruing loans. This table shows that there was some deterioration in commercial credit quality at JP Morgan and Citi. And the table shows commercial non-accruing loans, which are loans where the bank itself believes that it will not be able to collect. Now, at JP Morgan, total commercial non-accruals were up 33% year over year. And at Citi, they were up a very high 119%. But before you get too crazy, there were no problems at Wells Fargo or Bank of America or PNC Bank, where commercial non-accruals were down year over year. On the other hand, some problematic commercial loans emerged on Thursday at two regional banks, Zions and Western Alliance. Zions disclosed a $60 million charge-off for two loans where it looks like there was fraud by an investor group called the Cantor Group. And Western Alliance said it was dealing with the same exact bad investor group for a loan valued at almost $100 million. On that news on Thursday, Zions was down 13% and Western Alliance was down 11%. However, and this is really important, I would point out that no problems emerged at any other regional banks. So the problems at Zion and Western Alliance appear isolated to them. Of course, the market is hypersensitive to news like this. These days, everyone is looking for signs of credit deterioration. So on Thursday, the news from Zions and Western Alliance took the entire bank group down hard. So what are my takeaways about credit quality now that the banks have reported? I know that many people would just love to hear me predict doom and gloom like I once did. But I am data-driven. In 2007, I turned very negative because the reams of credit data I was looking at told me there were serious problems emerging. You need to understand something, that when banks report earnings, the disclosures they provide are incredibly detailed. Pages and pages loaded with information of every conceivable kind are disclosed, and not just for the entire institution, but division by division. So my conclusions about credit quality are not just an opinion, but driven by reams of data that the banks provided this week. My takeaway from looking at the credit quality statistics is this. Yes, Zions and Western Alliance made some loans to one fraudulent borrower. And yes, there was deterioration in commercial credit quality at JP Morgan and Citi. But other banks, like Wells Fargo, Bank of America, PNC, and other regionals did not show credit issues. Therefore, there are definitely signs of some, but only some deterioration in commercial credit quality at the margin, but not enough to cause or to indicate a looming recession. If and when the employment situation really deteriorates, we will see some real credit problems, but not yet. Now, let me explain further, because this is really important. Normally, the business cycle enters recession territory, and then companies begin layoffs, at which point credit quality deteriorates because people have lost their jobs and can't pay their loans. The Great Financial Crisis was different. Underwriting standards deteriorated so much, meaning people who should never have been given loans were swimming in them, that credit quality deteriorated first before a recession. And that pattern of incredible credit deterioration created the Great Recession of 2008. Right now, I think we are in a normal cycle. Yes, there are signs of credit deterioration on the commercial side, but not enough to actually cause a recession or indicate that a recession is about to occur. When a recession does occur, and I have no idea when that might be, but when it does occur, that's when we will see real credit deterioration. For those who invest in banks and need to check the rationale for their investment decisions, I'm now going to spend a little time going into the bank weeds. And for those of you who are not as interested in banks, you should also pay attention, because banks represent around 10% of the entire S&P 500. So even if you just own the S&P 500 index, banks matter. This valuation table that I'm putting on the screen tells you almost everything you need to know about how to value banks and how investors look at these companies. Like I described in my financial literacy masterclass, which I am plugging because I think it is really helpful in understanding which valuation metrics matter to each market sector and subsector, different industries focus on different financial metrics. And this matters because to invest in individual stocks, you need to know what each sector cares about. Each sector and subsector of the market really pays attention to very particular valuation metrics, and they actually differ across sectors. The key statistic bank investors look at is return on tangible common equity, otherwise known as ROTCE. And that equals net income divided by common equity less intangibles. This statistic tells bank investors how profitable a bank truly is. And generally speaking, the higher the ROTCE, the higher the valuation. And which valuation, you ask? Well, the price of the stock divided by tangible book value or tangible common equity. So, Morgan Stanley and JP Morgan have the highest return on tangible common equity, about 20% plus. So their price to tangible book value is the highest in the group, around 3 times. Now, Citi has the lowest return of only 8%. So its price to tangible book value is only 1 times. But I would quickly point out that Citi's ROTCE is finally improving after so many years, which is why Citi is back at 1 times tangible book value for the first time since before the great financial crisis. One more small point. I'd note that Goldman Sachs, Wells Fargo, and Bank of America all have roughly the same level of returns of around 15%. But Goldman's valuation is at 2.3 times, and Wells and Bank of America are at only 1.8 to 1.9 times, yet they all have the same level of returns. So why the premium for Goldman Sachs? Well, Goldman's earnings are very sensitive to M&A and trading, and we are at the beginning of what looks like an M&A boom. So some investors play Goldman for that because Goldman is the number 1 ranked M&A advisor globally. Wells and Bank of America are much less sensitive to capital markets than Goldman, hence the premium for Goldman. And in the regional bank world, last week, Secretary Bessent made what I think is really an incredibly interesting speech. He said that Dodd-Frank was supposed to end too big to fail, but has made it, he said, quote, too small to succeed for many banks. What did he mean by that? From a pure fundamentals perspective, this is actually a hard time for regional and community banks. Regulatory costs are much higher post-Dodd-Frank, but more importantly, technology costs have soared. And that's why the large banks keep taking deposit market share, because they can bear those costs much more easily. Regional and community banks need to merge, in my view, so that they can bear these costs and compete. Otherwise, they are going to go the way of the dodo bird. I note that 2 weeks ago, Fifth Third, a regional bank, bought Comerica at around $80 per share, which is only $10 higher than where Comerica was in, get this, in 1998. This administration is going to be, in my view, much more supportive of mergers of regional and community banks. And I think we are on the cusp of a major M&A wave in regional and community banks for the first time since the 1990s. So how do you play this? You buy the KRE index, which is a regional bank index. Now, I want to pause here for a second because I want to flag one real problem with this thesis. Generally speaking, the managements of regional banks are, to put it politely, not always the best. Take First Horizon. The company reported this week on Wednesday. Now, investors view First Horizon as a top takeover candidate. But on its earnings call Wednesday morning, the CEO said that First Horizon is, get this, open to acquiring other banks as opposed to being acquired. And on those comments on the call, the stock declined 9% on the day. Now, I'm sure many investors were incredibly angered by that statement by First Horizon's CEO. With one sentence, First Horizon gave up almost all of its stock performance gains for the entire year. And with that sentence, First Horizon took down the entire regional bank group. Sometimes CEOs should just keep their mouths shut. Final thoughts on bank earnings. Companies like Goldman and Morgan Stanley are well-run and heavily capital markets driven, and investors love to own them when that cycle is strong, like now. After that, they turn to Citi, Bank of America, and Wells. Regional banks just don't have as good fundamentals, and their managements, again, I'm being polite, are often not the best. So the only reason to own regionals is that they are going to get bought out. The problem is that you have to live with managements who should realize that the best thing for their shareholders is to sell the bank. But unfortunately, many of these CEOs just love being CEOs too much. Hence the comments by the CEO of First Horizon. Let me end the banks with adding some historical perspective. The banks, especially the large ones, have done very well this year. As the economy has avoided a recession, investors have made them a preferred cyclical play for the year. But never forget that in 2009, all banks were forced to raise large amounts of capital that diluted their shareholders. So yes, Citi is the best performing large bank this year, up 43%. And CEO Jane Fraser is doing a very good job. My hat is off to her. But at $100, Citi is nowhere close to its pre-Great Financial Crisis high of, get this, $557. Bank of America is also a very well-run bank and is up around 18% this year. But in the low 50s, Bank of America is still below its pre-GFC high of $54. Now I want to turn to Progressive Insurance. Progressive represents a type of business model that crosses several mature industries. Generally, when an industry becomes mature, just about every company in the sector gets reclassified from being a growth stock to being a cyclical or safety stock, depending upon the sector. But sometimes, within those mature industries, champions emerge, and what they do is become much more efficient than their competitors. And then they pass on those efficiencies to their customers in the form of better pricing. And over time, they keep taking market share. So in retail, Walmart and Costco fit this business model perfectly. And in cellular, it's T-Mobile. And in auto insurance, it's Progressive. Now, that does not mean that these companies are immune to competitive forces. Progressive reported this week. The earnings numbers were fine, but premiums grew by 9.9%, which is good, but slightly missed the estimate. Investors took that miss as a sign that competition in auto insurance is heating up, and as a result, the stock was down 6% on the day. Now, I've owned Progressive for years, and I continue to believe that you can own it for the long term. However, there are periods where auto insurance competition heats up, and the Progressive stock reacts negatively. This week, 36 companies reported, with the banks dominating. Next week, 92 companies report, and virtually every sector participates. So next week's wrap is going to be jam-packed. Now, before we end, I want to bring up a mailbag from last week. At the beginning of last week's wrap, I read a very long letter from a software developer named Max, who expressed his frustrations in using AI and questioned AI's efficacy. In response, we received a ton of responses, some agreeing with Max and some disagreeing intensely. So thank you everyone for participating in this discussion. Everyone added so much valuable information and insights, and I really appreciate the richness of content you all added. I'm the first to admit that I don't know enough yet to decide who is right and to what extent, but we deeply, deeply appreciate the dialogue. And that's the wrap. This week, we dropped an interview with Steve Eisman, Chief Economics Reporter at CNBC. Our discussion focused on what's really happening with tariffs, the spotty strength of the economy, the Fed and its relationship to politics, and Steve's time as the head of the Wall Street Journal's Bureau of Russia during the 1990s Yeltsin era. So check it out. And this Monday, we will drop an interview with two analysts, Craig Moffett and Michael Nathanson of Moffett-Nathanson, one of my absolute favorite research boutiques. Our discussion ranged from Apple's lack of an AI strategy to why cable stocks are such a disaster, to the demise of traditional ad agencies, to the rise of youth unemployment because of AI, to the need for streaming consolidation, and why Verizon suddenly fired its CEO. Hope you tune in. If you haven't already, please consider subscribing to our YouTube channel so you can receive these weekly wraps along with our podcast and the Financial Literacy Masterclass. Subscribing is the best way to help the channel, and we greatly appreciate your support. Also, be sure to check out our website, realeismanplaybook.com. There you can easily access all our episodes as well as the Financial Literacy Masterclasses that we have posted. Check it out, and see you soon. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.